Hello, everyone. So far, so good. So I understanding the computation of long-term assets, especially for investment, is a little bit complicated. So yeah, you need to spend some time to digest and know how to compute this kind of thing. And at the beginning of this video, I would like to review something about the accounting for long-term assets. Long-term assets means the assets will last more than 1 year or one accounting cycle. So it includes fixed assets, intangible assets, and investment, and so on and so forth. So we will have 3 procedures for this accounting, for the accounting for long-term assets. The first one is for the acquirement. When you purchase or have a long-term assets like investment or intangible assets, excuse me, intangible assets or investment. So in this procedure, and at this stage, we usually use transaction cost. Also, it's called a historical cost to measure the acquirement. So like debit, fixed assets, intangible assets, investment, credit, cash. So that's easy. And we have 2 things for this acquirement. One is identify. I mean, you need to figure out which category of assets should this spending for. If it's intangible assets, what kind of intangible assets? If it's investment, is a date or ownership, I mean, stock investment. If it's fixed assets, so you should identify what kind of assets it could be. And then the measurement usually is a historical cost. How much money you spend for these assets. And then because the long-term assets will cover more than 1 year, so we will have a special accounting at the end of each year. The reporting date usually is December 31st. We need to report this kind of assets in the balance sheet. So, for this procedure, actually, different assets will have different measurement, different accounting treatment. For example, for fixed assets, we use a historical residual value. That means book value minus depreciation as the number. And for intangible assets, we have 2 measurement instruments. One is historical value, book value. One is fair value. And if you forget that, please remind yourself, read the textbook. And then for the investment, in this chapter, we will have 2 measurement instruments. One is historic, and one is fair value. For example, for the second video for the held to maturity security, we use a historical, and the unrealized gains and the losses is going to the notes of the financial report. It's not recognized in the balance sheet. But in this video, I will show you the unrealized gains and the losses will be recognized in the balance sheet or interest income. Okay, And then the third procedure is the completion of the assets. You sell the assets, or it's finished in the company. Okay, we use these three procedures for the trading security in this video, and also for the available for sale security in this video. Okay, so what is trading security? Trading security is the motivation is just for bought and sold. It's just for short-term price arbitrage. I mean, if the price is higher than when I bought, then I sell it and make a profit. So the motivation is so usually this kind of a security have a very active marketing. Fair value is very accurate. So in the first procedure, when we acquire the trading security, we record at a cost. And then at the on the reporting date, I mean December 31st in each year, we need to report the investment with fair value. So, you know, fair value is a volatile measurement instrument. I mean, it's the price will change each day. So because we use the fair value, we will have unrealized holding gains and losses. Because we use the fair value to measure trading security, and the intent of the trading security is to profit with the trading, buy and selling. So these unrealized gains and losses will be included in the net income, I mean, in the income statement. We will see for the available for sale security, it will be different. Okay, and then the third procedure is after we sold the trading security, we will have realized the gains and the losses, and we will just recognize these gains and losses and put it into the net income in the income statement. Okay, we use an example to show that. So the example is Adam company, Kane the company purchased two securities. One is bonds. They carry, the stated interest is 9%, and another is 10% bonds. So for the 9%, there is a discount, $39,000, and for the 10% bonds, it's acquired at par value. That means it's the same as the face value. So, so at the acquirement, at the acquired day, on the acquired day, we will use the historical transaction cost to recognize this activity. So debit the investment in trading security, because it's the intent is to profit in a short time, and it's for making money. So it's for making money in by just using buying and selling and create the cash, because we spend $39,000 plus $15,000. And in the second procedure is recording interest income on the reporting day. So here, for the 9% bond, we need to accrue, deal with the discount, use the straight line method. Straight line method means the discount is 40,000 minus 39,000 is only $1,000 discount, and it's 10 years. The bond maturity is 10 years. So this $1,000 will be straight lined, allocated into each year. So in this year, this half year, because board on July 1st, and so December 31st is half year. So we need to amortize the discount. And in this period, the discount is $50. So we will receive 1,800 cash, and also amortize the discount of $50. So debit cash, 1,800, debit investment in trading security to amortize the discount, and credit interest income. And this interest income go into the income statement as late income. And then cash, and this is for the 9%. This is for the this is for the 9% bond. This is for the 10% bond. So for the 10% bond, there is no discount amortization, just the cash and credit interest income. The computation is easy. Just the principal times rate times period is half year. Okay, and then we need to also at the report on the reporting day, we need to recognize unrealized holding gains and losses, because it's a fair value. So the price will may change each day. So if the fair value on the reporting day is bigger than the requirement day, that means an increase in the fair value, then we have an unrealized holding gain. Otherwise, we will have an unrealized holding loss. So we need to recognize and measure this unrealized holding gains in the retained earnings. And this retained earnings is in the income statement. So we will show you the difference will be for the available for sale security. And a debit balance represent a later realized loss. A credit balance represent a later realized gain. See the example. Say on December 31st, the trading security is 56,500, and the detail is for the 9% bond, the value increase $1,950. For the 10% bonds, the price increased 500. So totally, the unrealized gains is 2,450. So David, investment in trading security. That means the assets value increase 2,450, and created unrealized holding gains trading security 2,450. And also it could it may have unrealized holding loss. That means if the price decrease, for example, on December 31st, 2020, if the 9% bonds increase $400, but the 10% bonds decrease 1,500, and then totally the trading security will lose $1,100. That means it's unrealized holding loss. So the accounting is debit unrealized holding gains or loss. It means it's loss, 1,100. And credit investment in trading security. Okay, that's the second procedure to on the reporting day to make sure the interest income and unrealized gains and losses. And then realize the gains and losses. That means is procedure 3. Is you sold this security and how much money you make a profit or have a loss. So in this case, is on January 1st, 2021, Kane sold this entire investment, and it's $41,000. The fair value is 41,500. So this 500 is realized gains and losses. So because the balance of the security is only 41,500. So here the 500 is unrealized. It's realized the loss because the balance is 41,500, and you only receive cash is 41,000. So debit, that's easy, right? Because you receive cash, and the balance number of the securities is more than the cash received, so it's a loss. So debit cash, debit loss on sale of trading security, credit investment in trading security. Okay, that's easy. And another one is to sell the 10% bond. So the balance at the end of 2021, Kane reports the fair value of the security it still owns. It didn't sell. The remaining security is 14,700. That means the price increases 700. So the unrealized holding gains debit investment in trading security, created unrealized holding gain and loss. Because it's still hold this security. So say on the December 31st of 2021, you still will report the balance of the asset. Okay. And then, so Kane reports the 500 realized loss on the sale of its investment in Adam company, and 700 unrealized holding gains on the boat company investment in its 2021 net income. And then So that's the three procedure. Remember, the interest income and unrealized gains and losses for trading security is directly going to the net income. Use the credit or debit unrealized holding gains and losses. Another security is available for sale. So the accounting procedure is same. It's similar. I mean, it's similar. There is a little, I mean, a very small difference over sure. So initially recorded at a cost in the first procedure, and then on the balance day, I mean, on the reporting date, usually is December 31st, we will report it at a fair value. And because of this fair value, we will have unrealized holding gains and losses. But here, the unrealized holding gains and losses for available for sale security is different from trading security. Because this unrealized holding gains and losses going to comprehensive income is directly going to a balance sheet to plus or decrease the comprehensive income. You know what the difference between net income and comprehensive income? Net income is in 1 year or 1 period, how much profit the company operated and make. Comprehensive income is directly added the value increase in the owner's equity. It's unnecessary going, it avoid through income statement. Why? Because this kind of unrealized holding gains and losses have some uncertainties. So the SEC and the FASB, the GAAP, want to avoid this kind of value increase or decrease different with the operating income. Okay, so we will discuss this in the next video.